Michael Burry was one of the investors who predicted and made millions during the housing crash of 2008. His large and unique bets against the market solidified him as a legendary investor. And today, he is the manager of Scion Asset Management, which has $230 million in AUM. Last week, all of the super investors' 13F filings came out. These filings require asset managers with over $100 million in AUM to report to the public all of the moves they're making within their portfolios. These 13 Fs are a goldmine of potential stock ideas, as we can see what the best investors in the world have been buying and selling. Michael Burry's 13F revealed that he has been adding to some of his existing positions quite substantially, and he added a few new interesting stocks to his portfolio as well. In the next few minutes, I'm going to take you on a deep dive of the 5 stocks that have caught Michael Burry's eye. We'll unpack what potential Burry might be seeing in them, and if they're still looking interesting today. Additionally, I have used Stock Unlock's AI to generate in-depth stock analysis reports on these positions. And if you would like to get these reports for free, then click the link at the top of my description. But with that being said, let's now hop into what Michael Burry has been buying in his portfolio. Alright, so right here we can see all of the positions in Michael Burry's portfolio and what he has been doing. And right away, we can see that he increased his Alibaba position by 24% in the most recent quarter, and Alibaba now makes up 21.3% of his entire portfolio. Next, we can see that he started a brand new position in the ticker symbol 4, which is Shift4 Payments. The next one is a brand new position, which is Molina Healthcare Inc. with the ticker symbol MOH, which is also roughly 14% of his portfolio and was a brand new buy. Next, we can see that he added 87.5% to his Baidu position, which is now 12.4% of his portfolio, and a pretty large position as well. He did sell off some of his JD, and he added a new position of HPP, which is Hudson Pacific Properties, and then sold off about 30% of his Real Inc. position. Then down at the bottom, we can see that there were 2 very small buys of OLPX and BCAB, but in this video, we are not going to talk about these 2 stocks because they are small positions within Michael Burry's portfolio. And I do think that these 2 are a little bit more like speculative stocks. So the stocks that we are going to discuss in this video are Alibaba, 4, MOH, Baidu, and HPP. And with that being said, let's start right from the top and talk about Alibaba. Alibaba reported its earnings last week, and I made a full in-depth video discussing Alibaba's earnings and going through all of the highlights for my viewers here on my channel. So if you're interested in getting a deep dive into Alibaba's stock, then I would definitely suggest checking out that video. But let's still discuss Alibaba stock in this video very quickly. So here we can see that back in 2014, Alibaba IPO'd around $90 per share. And now, literally a decade later, Alibaba stock is trading for about $81 per share. It's actually at about $84 today. This means that Alibaba stock is actually negative over the past decade since the company did its IPO. However, if we take a look at Alibaba's revenue, we can see that it is currently hitting all-time highs and is continuing to grow. However, if we take a look at the company's operating cash flow, we can see that it is coming down in the most recent quarters and it is not at an all-time high right now. This is partly because the company is selling off some of its non-core business assets and business units. The company has kind of been going through a restructuring phase, and I like to compare this with Meta's year of efficiency that Meta did in 2022 and in 2023. Alibaba is kind of doing the same thing right now, where it is sacrificing short-term revenue growth and profitability to set the business up to have more long-term potential and profitability. And Alibaba actually said in its most recent earnings report that 2025 is going to be the year where they start to see the benefits from the recent restructurings that they have been doing. In the most recent earnings report, Alibaba also reported that they have a net cash position of $55 billion now, and the company is trading for a market cap of $176 billion in the stock market today. So if we go 176 and we subtract the $55 billion of net cash that is on the balance sheet, then Alibaba has an enterprise value of around $121 billion today. Now, in the trailing 12 months, Alibaba has also done $24 billion in operating cash flow, which means that the company is trading for an enterprise value to operating cash flow of about 5 today, which is roughly a 20% operating cash flow yield for the business. Now, I am using the operating cash flow metric for Alibaba because they are investing a lot into capital expenditures and future growth right now. And they do say that they are getting high returns on this capital investment that they are doing. So for the time being, I actually think that operating cash flow is the best metric for Alibaba. And this is very similar to why I use the operating cash flow metric on a business like Amazon, because Amazon is constantly investing into high capital expenditures that do have a high return on invested capital as well. And an enterprise value to operating cash flow of only 5 does suggest that Alibaba's stock is looking extremely cheap in the market right now. In fact, if we want to take a look at Alibaba's price to free cash flow, it is still sitting at 10, which means that the company does still have a free cash flow yield of 10%, even after the high capital expenditures that they are doing. So if Alibaba wanted to pay out 100% of its free cash flow right now as a dividend, then investors could be receiving a 10% dividend yield on the cost of the shares today, which is a large amount of capital that Alibaba could return to its shareholders. Now, really quickly, I want to go and do a discounted cash flow calculation on Alibaba using its operating cash flows over the next 5 years. And we are going to say that Alibaba is going to grow its operating cash flow at 4% annually and buy back about 6% of its shares on an annual basis as well. We're also going to say that the company is going to trade for a price to operating cash flow of 10, which is well below its 5-year average of 15. And with these inputs right here, which in my opinion are quite conservative, we can see that Alibaba's stock could still produce a compounded annual growth rate of 15% for its shareholders. So to put it simply, I think that Michael Burry is adding to his Alibaba position and making Alibaba over 20% of his portfolio right now, because Alibaba stock is looking extremely cheap in the market. I do understand that there are risks in China with the CPP and the government, but for an enterprise value to operating cash flow of only 5, I do think that these risks are being priced in, and that is why Alibaba is in my own portfolio as well. All right, so now let's move on to the next stock that Michael Burry has been buying, which is Shift4 Payments. Now, this company IPO'd in 2020 at about $35 per share, and since then the stock has been quite volatile, and now it is trading for about $82 per share at the time of recording this video. Shift4 Payments is a payments platform, but what makes this company unique is it creates software in addition to the payments platform. For example, Shift4 Payments has a technology called SkyTab, which they say is more than just a POS system. It's an all-in-one restaurant platform that will transfer your business from front of house to back of house and everything in between. So this is like a restaurant management platform that also happens to have a point of sale system built into it. So again, Shift4 Payments is not just a POS platform, but they also have different software and technologies for different industries such as restaurants. And the restaurants use this technology to help manage their businesses as well. Shift4 Payments also recently reported their earnings, and I went through the recent earnings report and found some of the highlights that I think investors need to know. Here we can see that the company saw 50% year-over-year growth to its end-to-end payment volume. It also saw its revenue increase by 30% and its gross profits increase by 38% year-over-year. So this company is seeing very strong growth right now. On this next screenshot, we can also see that their end-to-end payment volume came in at $40.1 billion in the most recent quarter versus $26.8 billion last year. And we can see that their end-to-end payments volume has nearly 10x'd since the second quarter of 2020. The gross profit also came in at $320.6 million versus $228.1 million last year. And lastly, we can see that net cash provided by operating activities did come in at $116.1 million versus $91.9 million last year, which is growth of 26% year over year. Free cash flow is also up 18% year over year. So the company's revenue is growing, and it looks like its profitability is growing with the revenue as well. Shift4 Payments also does a shareholder letter every single quarter that is written by the founder and the CEO. And I found some interesting paragraphs in this letter that I want to share with you. So the first one here says, "What is the opportunity? Clearly, there are winners and losers in payments. The losers provide little value beyond the approval and decline of a credit card transaction, and as a result, there is little they can charge for that service. The winners are bringing together software plus payments to deliver a more powerful commerce experience, and they can typically charge more for the value being delivered. At Shift4, more than 99.9% of our transactions are integrated into software, predominantly card present, which is not easy, and in verticals that require a lot of software to adequately serve. It is important to realize there is not a single restaurant, hotel, sports stadium, or theme park switching to an inferior commerce solution solely to save a few basis points." So Shift4 is saying that nearly all of their payment transactions happen on their software solutions that they have built. Again, like the restaurant example that I provided earlier. And they're saying that their customers are not switching to these other POS platforms just to save a couple of basis points on their transaction fees. Then the CEO also writes, "Why do we do M&A better? Our corporate DNA is about winning. We want to win as much as we can, deploying the fewest dollars with the absolute highest returns. If we wanted to hire employees, invest in a project, or acquire an asset, we funded it with our own cash flows. I would rather deploy capital on high probability outcomes than throw it at digital marketing, mass hiring, and hoping for the best. Shift4 also does a lot of M&A, so they are kind of like a serial acquirer within the payments industry. And the CEO and founder here is saying that he focuses on high return capital investments, and he doesn't want to just throw more money at digital marketing or mass hiring to hope for the best, because these investments may not yield high returns. And personally, I do really like how the CEO is talking here. And Shift4 does have a history of doing solid acquisitions that create immense shareholder value and profitability for the company. Then Shift4 gave us some of their guidance. And right here we can see that their end-to-end payment volume guidance is $172 billion for the year of 2024, which is up 58% year over year. Revenue is also projected to grow by 47% this year, and adjusted EBITDA is projected to grow by 50%. In this next slide, they also show us that they're expecting $399 million in free cash flow for the year of 2024. Now, if we head back over to Stock Unlock, we can see that Shift4 is currently selling for a market cap of about $6.96 billion today. So if we go $6.96 billion and we divide it by the $399 million in free cash flow that they are projecting to produce in the year of 2024, then we get a price to free cash flow of about 17.4. And this is a business that is growing its revenues by 30% annually and growing its cash flows strong as well. So a 17 price to free cash flow for a business growing this quickly, I actually do think is quite attractive. It's also worth noting that the CEO is the founder of the business, so this is a founder-led business. They have a strong track record of acquiring competitors at high yields, and the CEO is the largest shareholder of the business. So there are a lot of things to like about this business, and out of all of the stocks that Michael Burry purchased in the most recent quarter, I do think that Shift4 is the one that is looking the most interesting, because the stock does not look overly expensive, the company is seeing very high rates of growth, and the CEO is the founder, who I do think is aligned with shareholders because he is the largest shareholder himself. So for all of those reasons, I do actually think that Shift4 is looking quite interesting and is worth putting on your watch list. All right, now moving on to the third stock that Michael Burry has been buying is MOH, or Molina Healthcare Inc. MOH is a health insurance company that provides Medicaid, Medicare, and other government-funded health insurance programs. Now, why I think that Michael Burry may be buying this stock is because Medicare expenses are projected to grow by 7.4% annually all the way out to 2032, and Medicaid expenses are projected to grow by 5.2% annually over that same time frame. Additionally, Medicare enrollment is projected to increase up to 60% of the eligible Medicare population by 2030. So more people are projected to sign up for and use Medicare all the way out to 2030. And with the average Medicare expense and the number of people using Medicare both expected to grow, this should provide two tailwinds to MOH's business over the next 6 years. Now, if we head back over to Stock Unlock, we can see that MOH has done very well over the past about 20 years now. Especially if we zoom in over the past decade since 2014, the stock has about 10x over that time and has massively outperformed the S&P 500. If we take a look at the company's long-term revenue, we can also see that it is currently hitting all-time highs, and it looks like the revenue growth is starting to accelerate in the most recent quarters. However, if we take a look at MOH's net income, it hasn't been growing in line with the revenue, and in the most recent quarters, it's actually been downtrending a little bit. And the company has produced about $1.06 billion in earnings in the trailing 12 months now. So let's go take a look at MOH's most recent quarter highlights to see if we can get some more insights here. And this says, as of June 30th, 2024, the company served approximately 5.6 million members, which is an increase of 8%. Premium revenue was approximately $9.4 billion for the second quarter of 2024, an increase of 17%. Adjusted net income was $5.86 per diluted share for the second quarter, which was an increase of 4%. And the company reaffirmed its full year 2024 guidance of earnings per share of at least $23.50 per diluted share. The CEO also said, "We are pleased with our performance in the quarter as our flagship Medicaid business continues to perform well, along with strong contributions from both Medicare and marketplace businesses. We have successfully navigated the unprecedented redetermination process, and these highly attractive businesses provide the foundation for near and long-term sustained profitable growth. So it sounds like the CEO is quite optimistic and bullish on the long-term profit growth of MOH. And it seems like the business went through a little bit of a restructuring period, or a period where GAAP net income was a little bit lower. However, the company is projecting adjusted earnings per share of $23.50 for the year of 2024. So if we head back over to Stock Unlock and enter in the current share price of $346.20 in after-hours trading, and we divide this by $23.50 of earnings per share projected for 2024, then we get a price to earnings ratio of about 14.7 for this business. This business also saw its revenue grow by 17% year over year, and its GAAP net income grow by 4% year over year. And I do think that a price to earnings ratio of 14 seems reasonable for a growing business that is essentially government funded and projected to continue seeing some pretty strong growth all the way out to 2032. All right, now the fourth stock that Michael Burry has been buying is Baidu. Now, for those of you who may not know, Baidu is like the Google of China, because they are the #1 search engine in China. If we take a look at Baidu's stock chart, we can see that this company IPO'd in 2005 at roughly $8 per share. So since its IPO, it actually is up roughly 933%, and it has been massively outperforming the S&P 500. However, this stock has been extremely volatile, especially over the past decade. Here we can see that Baidu was roughly $99 in 2010, and today the stock is trading for about $90 per share. This means that the stock is now flat over the past 14 years and has not produced any returns for its shareholders over that time. However, if we go and take a look at Baidu's revenue, we can see that it saw a period of massive growth from about 2008 to about 2018. And Baidu's revenue is still hitting all-time highs today, and the business is continuing to grow. If we also take a look at Baidu's operating cash flow, we can see that it is hitting all-time highs today, and it is continuing to grow. If we head over to Stock Unlock's Freeform tool, we can also see that Baidu had $25 billion of cash in its most recent quarter. And if we take a look at the company's total liabilities, we can see that they are sitting at about $23.3 billion, which means that Baidu has more cash than total liabilities. Or in other words, its balance sheet is looking incredibly strong. Baidu's market cap is also sitting at $30.3 billion today. And again, its cash position is sitting at about $25 billion. This means that Baidu's current cash position is almost the same as its market cap, which could suggest that the stock is looking quite cheap right now. Baidu is also trading for a price to free cash flow of about 5.9 today, which is a free cash flow yield of around 17%. So just like Alibaba, if Baidu wanted to pay out 100% of its free cash flow as a dividend to its shareholders, then it could pay a roughly 17% dividend yield on the cost of these shares today, which is a significantly high dividend yield. And this business is continuing to grow its revenues and its cash flows. So there just seems to be this massive discount on Chinese stocks today. And it looks like Michael Burry is taking advantage of this discount and adding more to his Baidu position and making it a larger position in his portfolio as well. Baidu is also reporting its earnings this week, so it will be interesting to see if the business is continuing to grow and if the discount on the stock is continuing to grow as well. All right, now moving on to the fifth and final stock that I want to talk about in this video is HPP, or Hudson Pacific Properties, Inc. Again, this was a new buy for Michael Burry in the most recent quarter, and he made this stock about 10% of his overall portfolio. HPP is an office real estate investment company. And here on their website, they say, today, from Los Angeles headquarters to Silicon Valley to San Francisco to Seattle to New York to Vancouver and to the UK, we own, transform, build, and operate marquee office and studio properties. So HPP owns, invests, and builds office real estate properties around the world. Now, if we head back over to Stock Unlock, we can see that the peak for HPP's share price was $38 per share before COVID happened in February of 2020. Since then, we can see that the stock is now down roughly 88% from its peak, and it is now trading for $5.22. So this stock has been absolutely decimated. And even right here back in March of 2022, this was a $28 stock, and then it saw a massive decline of about 84% within a year. So the market seems like it is not optimistic on HPP's business at all today. So let's take a look at why Michael Burry may be interested in this stock. If we head over to HPP's revenue, we can see that it has declined in the most recent quarters, and it looks like its revenue is still coming down. If we take a look at its operating income, we can also see that it peaked here in 2022, but since then, the company's operating income has actually declined all the way down to negative $22 million. So this company's operating income is now negative. Next, let's take a look at the operating cash flow. And once again, we can see that operating cash flow peaked in 2022, and it has now been basically cut in half to 181 million. And it looks like the operating cash flow is continuing to decline. So let's go and take a look at their most recent quarter and take a look at some of their office real estate metrics here. And here we can see that the number of properties that HPP owns has remained consistent over the past year at 41 properties. However, the average occupancy rate in these properties has declined by about 7%, down to about 77.6%. The average percent leased has also declined by 10% to 76.1%. And the overall office revenues have declined by about 7.9%, and the same store office net operating income is down 13.9%. On the company's total real estate portfolio, its same store net operating income is down 13.2%, which is most likely being led by its overall occupancy declining by 7%. So overall, it looks like the fundamentals of this business and its occupancy is continuing to decline on a year-over-year basis. So let's go and take a quick look at HPP's balance sheet. And right here, we can see that its book value is currently sitting at 3.13 billion. However, its book value has been declining since about 2016, and it's down about 20% from 2016 levels now. However, the market cap of this business is currently about 724 million in the stock market today, which means that the company is trading for about 0.3 times book value. And maybe this is what Michael Burry is seeing in the stock today, because it's literally trading for about 30% of book value, which is well below the estimated value of the company's properties or its assets. So maybe this is like a deep value investment that Michael Burry is bullish on, or maybe he thinks that this is kind of like a turnaround play in the market when office real estate starts to recover. But to me, this business does not look very attractive because its revenues are declining, its operating income is now negative, it looks like its cash flows are also declining, and I'm not too confident that the book value of this business is actually going to remain because the book value has been declining. And if the office real estate that this business owns gets reappraised at a lower value, then the book value could also take a pretty big hit as well. So to me, personally, this business does not look that interesting at all, but I do see why Michael Burry may be interested in it because, again, the price to book is quite low. So those are the 5 stocks that Michael Burry has been adding in the most recent quarter. And out of all of these stocks, I like Alibaba and For the best. Baidu also seems to be very cheap, but it is another Chinese stock. MOH also seems like it is almost certain to continue growing over the long term. And HPP seems like it is your typical value investment, but is also a lot more risky and is the one that I am the least interested in. So let me know what you think about these 5 stocks in the comment section below. And also remember, if you want to get Stock Unlock's AI stock analysis on these stocks, then make sure to go and click the link in my description to get your free reports on these businesses as well. But with all that being said, that is going to wrap up the video for today, everyone. So thank you all so much for tuning in. And if you did enjoy the video, then please remember to leave a like on it as well. And with all that being said, thank you all again, and I hope to see you all in my next video.